Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So this is one of my favorite strategies to look at, and the other one is a reversal pattern. And I call it a momentum reversal because we're looking at a shift in the overall momentum. Oftentimes this takes place as a trend is nearing exhaustion, or a larger upward swing within a trading range is nearing exhaustion. And what we're looking at for the momentum shift is that you'll have a strong initial leg of buying or selling, and then you'll have a shift in momentum in that trend channel. So it'll create a series of highs where when you connect the highs and then you connect the lows in between them, and then you transect that entire move, you see this shift in momentum that has taken place. Now, each of these swings into a new high, they can have that same momentum as that initial run up, but the entire channel changes momentum because you have a series of only slightly higher highs. Or if this were taking place at lows, you would have a series of slightly lower lows. And basically what happens is that each time that makes a higher high, it's trapping more people. And as it pulls back, people become more concerned that it's not really showing the strength that it showed initially. And they become more worried about actually trying to make a gain on the security. So when it does it for the third time, usually that third time is the key. And once again, you're looking at time development. So the amount of time between each of those three highs is really important, just like the amount of time between each of those three waves of buying was when we looked at trend development earlier. So between 1 and 2 and 3, you want those to be fairly comparable. You can still get a momentum reversal if they're not comparable, just like you can still get a trend reversal if the corrections aren't comparable. But it's going to be a stronger setup if they are. There's two ways that you can enter this particular trade. When you're looking at the two-wave continuation pattern, the way I entered that was when that channel for that second wave broke lower, that would give me my trigger. So instead of taking like that entire congestion break, I would look for a break in that second channel for a trigger, and my stop would be, in the case of a short, above that second high. When you're looking at the momentum reversal, there's a couple of ways that you can place an entry trigger on this. The first one, if you're lucky enough to catch it and see it in time, is going to be to use this push into the third high itself. And when the channel from that breaks to the downside, that will trigger your short. So your initial short trigger would be as that channel breaks from that third high. Now, sometimes you don't see this pattern until it's already taken place, so you don't want to just kind of jump on board. But a secondary option is to connect those two lows between the two highs and extend that and use that as a channel break. A lot of times what I'll do is, as it comes down into that, you'll see some sort of reaction at that lower end of the zone, so you might get a little bit of a pause here and then a continuation, so you can take a break on that smaller time frame that will give you that option for the continuation. Now the stop is going to be over that third high. Unless you're managing to take it on a continuation move like down here and it bases, and then you can place your stop over that little bit of a base to kind of narrow your stop there. Now on FCG, we're going to go back and we're going to look at this on a weekly time frame, because we just had so many that were forming on this weekly time frame that I wanted to show you a lot of these here. And the first one took place back at the end of 2008, and we were heading into the start of 2009. And this is a little bit of the higher risk one because there's a little bit more of a difference in terms of when the first and second low form compared to the third low. Now, earlier I mentioned that it's best if they actually have evenly spaced lows. So your first low, your second low, and your third low. This is a little bit of a variation, but you've got the 3 clear-cut lows. You have 2 corrective moves in between, 1 and 2. And so the break in that channel coming off the third low gives you that initial entry trigger. A lot of times what I like to see is that the momentum coming off that second low is a little bit more of a V. So if here is the momentum reversal, you have more of a V type of pattern coming off of this second low. And that will just increase the odds on the setup, as opposed to here we've got a 2-wave continuation that is formed that leads into that third low. Now, the secondary entry is that channel break here. And the stop is under that third low. If you drop down and you look at the smaller time frames, a lot of times you'll find like continuation patterns that will form on those smaller time frames that will help give you an idea of where you can set up and take this setup a little bit more quickly than you would on a daily trigger. So this here is a weekly time frame, so you drop down to the daily and look at the 60-minute, and that can help you by forming these little tiny little bases. They will give you a continuation move as well. Tina is asking if I use any momentum indicators, and what's actually interesting about my style of trading is that since I basically taught myself technical analysis, I didn't learn a lot of those indicators to start with. I didn't learn things like Bollinger Bands or stochastics or even a commodity channel index. Those sort of things were just not things that I was introduced to at that time and really didn't look at until several years down the road. And by the time I put them up, I realized, you know, I'm already making the same observations without cluttering up my charts with all of these indicators, because the indicators are basically trying to give you a visual representation of what's already going on in price action. And instead, my system focuses upon the building blocks of price development. Well, that's what I call them, are the building blocks of price development, because I'm not really looking at a pattern as like an overall picture like a lot of the textbooks on technical analysis will teach you. They'll say, you know, here is a reverse head and shoulders pattern, for example. And they'll say, well, to take a head and shoulders pattern, you take the neckline break. So here's the neckline, and so here would be your trigger. And I go and I look at that and I say, why are you trading that there? You're kind of a little bit late to the show. I would never take a head and shoulders pattern as is traditionally taught in technical analysis. Instead, I drop down and I look at the components of what's going on here. So I'm looking at the momentum of this shoulder here, and I'm looking at the volume on the shoulder. I'm looking at the trend placement of this pattern in a larger trend, and if there's any correction periods that are forming as that right shoulder forms. And usually my trigger ends up being the channel break of that right shoulder. So it would be about here. And interestingly, it's often a 2-wave continuation pattern where you've got the 2 waves that have formed within that right shoulder that give you the trigger. So I don't use any momentum indicators, but with a momentum reversal, if you want to, one of them that does work pretty well is a MACD divergence. So what you will typically see here is that your MACD will have that high here, and then in the second one it'll have a lower high, and then a third one it'll have an even lower high. So it'll basically look like that as each of these lows are being made. And the same thing as it's forming at the high. It'll be higher, lower, and then lower. So you're dealing with a divergence there. The second pattern is over here, and we're looking at a short pattern. And here's our initial upswing off of the lows, and then here are our 3 highs. And you'll notice that there's a smaller little high in between highs 2 and 3 that I actually ignored. And the reason I ignored that is because it's very important that you're dealing with slightly higher highs each time. And when there is, one way of looking at this is that when there are 2 highs where one of them is slightly lower than the last, you can actually connect these and cut that in half and treat it as a congestion zone, and use that middle of that congestion as your identification for the second high. And that's quite common where you'll have a typical high, and then you might have like congestion here as it's heading into a second high, and then you'll have your third high. But maybe this looks a little bit higher here, maybe it looks a little bit higher here. So I'll take the middle of that congestion and consider that the second high. So you're getting into here as some of the more intricate details of this strategy, but that's how I do it. So you know, look at that and consider the variables and how you can really see different variations of this. You'll start to pick up more of these the more that you trade them as well. So on this pattern, here's the entry trigger as that channel breaks into that third high. Again, it's a slightly higher high. If you miss that, you can take that channel break. And here's where I like to look for after that channel breaks, as it comes into that channel break, I'll look for something smaller to get into it, because a lot of times there is some sort of reaction off of that channel break that you can use for a continuation pattern. Now, in this case, we don't have a strong continuation of the move. What you would want it to see on this kind of hits that first target level, which is basically where the momentum shift begins. But when it hits that first target zone, by the way, this would be the first target zone here, because it's where the momentum shift first began. Instead of basing and forming a decent two-wave continuation move on the downside here, which would be common, it often will form a two-wave and then head lower. What it does is that the second low ends up being slightly lower than the first low. And by doing that, that's sort of like, uh-oh, it might pause and reverse and continue higher again. So ideally, for this to have continued on the downside, we would have wanted to see a two-wave continuation where it would have looked like this. And when it made that second low, it would have been higher than the first low, even just slightly higher than the first low. By being slightly lower than the first low, it creates more of a trap, and it makes it higher potential that you see another momentum reversal pattern that actually will turn that trend back around, which is what we saw end up happening here. Here's another couple of examples. And again, this first example, here's the slightly lower lows, but there's a wider difference between that second low and that third low. And because it did that, it increased the risk that it's not going to be as strong of a setup. And the end result was that a little bit farther down the line, it ended up breaking lower instead of turning the trend completely around. And I like to show you guys a lot of variations because, I mean, the fact is, you know, things aren't always textbook. You're going to see variations. But there's certain characteristics that are going to increase your odds, and then there's characteristics that are going to decrease your odds. So when you have the lows that are evenly spaced, that's going to increase your odds on the setup. You can still get the setup where the lows are not evenly spaced, but the potential and the return on them is typically not as strong. So it can come into where this channel breaks, basically, but that's going to have a harder time breaking if the lows are not more evenly spaced. When they're more evenly spaced, you're more likely to see this bounce, give us a two-wave move here, and then the continuation on the upside. And that's why I put these two strategies into this class, because they work so well together. Oftentimes, the next strategy you will see that follows the momentum reversal is going to be a two-wave continuation off of the low, if it's a momentum reversal buy, or off of the high, if it's a momentum reversal short. Here's a little bit of a better momentum reversal over here when it starts to shift again, because we've got the more evenly spaced highs. Again, this is kind of a congestion move here, so you can actually cut that congestion in half, and then you can see that the highs look even better. And sometimes people will say, well, it looks like you're just manipulating what the chart looks like. And you're not really manipulating it, because a lot of times this will have been that very first high, but since it's a congestion, you want to cut it in half. And this is just something I discovered after many years of trading the strategy and following the strategy and trying to figure out, well, why does this one work when they're not evenly spaced, but this one doesn't work when they're not evenly spaced? And it's because the one that worked will typically have had that congestion that altered how they were evenly spaced, whereas the one that didn't work didn't have the congestion. It was more like this, where they weren't evenly spaced, but they were very clear-cut lows. If this had formed more of a congestion, rounded off, based right here, and then bounced, you would have cut that in half. It would have spaced the lows more evenly, and you would have had a better strategy, a stronger buy setup coming off of that low. So yes, you're manipulating things, but you're manipulating them in a very strategic manner, meaning that every single time I see a congestion with a couple of highs after the momentum has slowed, which is what has happened here, the momentum slows right here, and it comes into another high. So you are manipulating it, but you're paying attention to the fact that this did slow down here. So it's already showed that it is correcting off of this zone here. So it's a very strategic manipulation of what it looks like. Now, in this case, coming off of this high on the third time, you've got that channel break at approximately the same place as this third high is. So your entry trigger both times is really about the same. And it's also a break in that 20-period moving average. So a break in the support level is also a really strong confirmation trigger. And again, lighter volume as this pushed up. So it's another indication that there really wasn't a lot of upside action on that. Tina asked, do I drill down to shorter time frames? And yeah, I mentioned this earlier at the start of the class. And definitely, if you can, drop down to a smaller time frame, because it's going to help you with the timing. Even with this channel break here, you could have seen it more clearly if you were looking at a 60-minute chart, and this is a daily chart. So drop down to the 60-minute, and that can help you with trading that channel break as it's coming into that third high or that third low. Here's that same pattern that's forming on this daily time frame, but on the weekly. And what you'll notice is that this congestion in here ends up being that first low on the weekly time frame. This is the second low on the weekly time frame. And then here's the third low on that weekly time frame. And I'll make this a little bit bigger here so you can see it again. So here's congestion, where we have like these three smaller little lows here. If you take those and cut it in half, it gives you that low there. So your lows are now more evenly spaced than if you take the absolute low. So you start where the momentum actually shifts into where it forms that low. Divide that. And then here's a channel break here to give us the trigger. And a secondary trigger would have been as this channel broke. And again, particularly when I'm taking the overall channel break between the three lows, this one here, I like to drop down to the smaller time frame, because I don't want to get something that has been rallying for 3 days straight and then breaks the channel. Typically, that's going to lead to a longer congestion before it gets going again. So you can see it formed 3 days of upside here. It almost hit that channel break, and then sometimes it actually will. It'll pull back up here, pop just above that line, and then congest and give you the continuation. So instead of doing that, I like to watch for a continuation move like this, where then you have that additional channel break that confirms the momentum reversal here. So we're about out of time here, and I want to leave some time for some questions. I know we covered a lot of material. There's, even within each of these individual strategies, the one thing that you have to keep in mind is that there's dozens of variations of these strategies alone, and it really depends upon how those building blocks that are creating these strategies shift. So the momentum move within a two-wave continuation move will affect its outcome. But when you put them together, these are definitely two of the strongest patterns that I've come across in 14-plus years of trading, where I'm really confident in these pretty much every single time I come across them. And I think that they're the easiest ones for newer traders to pick up on as well, because you can really develop very clear-cut pros where I'm going to take it only if this, and this happens. Like we saw variations where the three lows were not evenly spaced, but if you're just starting to trade this strategy as the momentum reversal, don't try to mess around with, trying to cut it in half if the low is rounded off here. Look for very distinct lows, And that's going to give you a better strategy and more confidence as you get started. And then as you start to become more familiar with the strategy and you've seen a ton of variations of the strategy, then you can start trading more of those variations. But stick to more of the textbook type of examples to begin with, like we saw with the templates back here. And you really do find a lot of them that look quite textbook. If you're trading the index futures, for example, and you're trading off of, say, a 100-tick chart, you're going to come across this momentum reversal throughout the trading day, usually 3-4 times within a single trading day. So it's something that you can drop down to smaller time frames and look for more examples just to kind of get a better feel for it. And a lot of those are going to be nearly textbook strategies.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.